Hi everybody, this is part 15 of my deep dive into Rivian. We finished part 14 talking about a potential honeypot hidden within Rivian's guidance. I explained how my highly optimistic forecast results in the optimistic end of Rivian's guidance, even though the first time introduction of a range suggests some uncertainty in their forecasting. The management also pointed out various potential risk factors to the outlook. And to kind of dive deeper what this honeypot might be, let's jump back to the discrepancy that I pointed out earlier. So this slide from an earlier video, I discussed why we have a discrepancy in what the management said. I'm not going to recap what I said here, but so big picture, the honeypot that Rivian is not talking about could be this. So the gross margin on the VW JV revenue recognized. I'm, as I said previously, forecasting this with this gross margin assumption. The gross margin is actually not an input factor, it's an output, and because the gross margin is driven by running off the deferred revenue liability that Rivian created as of December, 1.96 billion from the VW JV, and by looking at the total segment's gross profit margin, 30%. By stripping out the service and other segment, you can infer how much gross profit the VW JV has to generate. And combining this profit with the runoff of the deferred revenue liability, you can plot this implied gross profit margin. However, based on management commentary, this should be 100%, but it doesn't line up with the 30% margin as I explained previously. For that reason, the discrepancy could be the honeypot that I was banging on about when I talked about the EBITDA. However, the key takeaway is, when you look at this gross margin profile, what I'm saying is that basically a little over half of the deferred revenue flows as gross profit through Rivian's financial earnings. The total deferred revenue is 1 billion. So if this is truly the honeypot that is kind of implied, then there is an incremental 1 billion in gross profit, or I call it pure profit, hidden in Rivian's forecast. But here's the big picture. Because losses are still so enormous, and because this gross profit does not emerge just in 2025, but this runs off over 4 years as the CFO guided, I say they probably can do it much quicker. I forecast 3 years. This 1 billion is distributed and, according to Rivian, back-end loaded over this at least 3-year time frame. So this means there is roughly a, call it 300 to 400 million upside at most in 2025 or 2026. Now when we jump to the operating profit, you can see on 3.3 billion in operating losses in 2025, 300 to 400 million is not going to do much. It's like a 10% delta roughly. And the same is true for 2026, where they still have 3.1 billion. So even if this is an underestimation here in my forecast, this would not dramatically change the picture. Yes, 10%, 15% deviation is quite meaningful, but given the enormity of the losses, it's still not changing the fundamental picture of the company. So the main aspect to this is really not to buy basically Rivian's BS, because if you remember, the 4Q 2024 profitability, gross profitability, was exclusively driven by a one-off, which they didn't disclose to us. They just said gross profitability. Hence, they did quite well using this clever trick. So now I conjecture a little more. Let's assume this honeypot is really hidden here in the release. So what they might be doing, they might be strategically release that honeypot to boost gross profits, because again, it doesn't move the needle in operating profits. So they will always keep pointing to the gross profits, but my advice to you as an investor is you need to look past the gross profit discussion. It's a red herring, as I hopefully this presentation demonstrated to you, because I think Rivian will be using this honeypot if it exists. Again, there's a lot of conjecture here, but based on everything that is close told us, there's a chance there is some item here. Otherwise, my very optimistic forecast nailing the lower end or the optimistic end of the guidance doesn't quite make sense. So big picture, what I want you to take away is, if there is a gross margin or gross profit surprise, look very closely at operating profits. This is what you should be looking at. The other stuff can be gamed, but operating profit is much, much harder to game. So with that out of the way, let's talk about free cash flow. Because ultimately, over the long term, free cash flow is the ultimate metric. All other high-level metrics have some or higher degree of accounting noise in them. So this chart is quite busy, so let me just walk you through how this works. So here down in blue, you see the quarterly free cash flow development. This is shown in millions, and when you look at this time series, it looks a little odd. It's all negative, except there is one massive positive outlier. So actually, it is true, Rivian's free cash flow was positive in 4Q, but not even Rivian dare to talk about it. And you know why? Because this was also entirely driven by a one-off item. Rivian recognized in one go the entire upfront payment for the next 3 to 4 years, or they didn't recognize it's the wrong way to put it. They received the cash from VW already. So VW transferred 1.96 billion in payments to Rivian. So Rivian got all the money. It's very similar to Tesla when they sell FSD, but it's not quite ready. So let's say Tesla charges you, let's say 6K for it, but it's, let's say 50% ready. So they only recognize 3K in revenue, but put the other remaining 3K onto the balance sheet, create a deferred liability. And as they satisfy more of the performance obligation, they release some of the 3K set aside in the P&L over time. This is precisely what happens in Rivian's case. So they got the 1.96 billion in December, created a reserve, and as they deliver milestones, they will release some of that reserve in the P&L. But importantly, they already received the cash. The cash sits on the balance sheet and is therefore, once they recognize it in the P&L, a non-cash earnings contribution. So anyway, so you see this cash flow, so you can basically ignore this 856 billion positive for that reason. And if you strip out this one-off item, the free cash flow is actually pretty much unchanged quarter over quarter. Rivian kept burning through 1.1 billion in cash. So what does burning cash mean in terms of negative free cash flow? It means that your operating business, and operating business is basically, think about, okay, what's the purpose of your business? By pursuing, executing on your purpose of your business, the cash that business brings in, less what you invest to keep the business running and make sure you have a future product, etc., minus that cash called capex. What's left is what your business generates. That's why it's called free cash flow. So now you have the free cash. Now you can do some other stuff with it. But this is the free cash flow. And in Rivian's case, the business is simply deeply loss making, because, as I always half jokingly say, Rivian is selling $2 bills for $1 bills. And then please note down here the formula for free cash flow. I said this earlier, this is operating cash flow less what you spend on capital expenditures, or you can call it investments. And this results in the free cash flow. And in the next video, we will discuss the drivers of free cash flow. Thank you very much for listening. See you in the next one. Bye.